Fools, we're so fortunate to be joined by Timothy Arndt, the Chief Financial Officer of Prologis today, the world's leading logistics real estate company. Prologis owns properties spanning 1.3 billion square feet, over 200 billion in assets under management across 4 continents and 20 countries. Its 6,500 customers include major global companies such as Amazon, Coca-Cola, Walmart, UPS. This is what always blows my mind. An estimated 2.9% of global GDP, which I think is like 90 trillion right now, flows through Prologis' warehouses, logistics, and fulfillment centers each year. Tim, thank you so much for giving the Motley Fool some of your time today.
Yeah, glad to be here, Matt. Good to see you and Anthony.
Thank you. So before we delve into the business of Prologis, I'd love to get your not so humble opinion about something, if you don't mind. And I know the stock is up a little bit today as we're taping. Do you think $110 is a reasonable share price for Prologis? Or would you offer a different assessment of the price?
Great way to start. No, I do not think it's reasonable. I'll start here in real estate, and some of your listeners may know this. I think historically there's been a concept of just NAV, looking at simple real estate companies of what is pure liquidation value of this company, if nothing else. What's the fair value of all the assets, pay off whatever debt is there, what's left. And that has been kind of, for worse, I would say, better or worse, but for the worse over a long period of time, a pretty poor way of valuing real estate companies, especially ones like Prologis, because obviously it's not picking up anything about the enterprise value, all the platform value of various businesses that Prologis has. But if I even begin there, consensus NAV out there from the analyst community would have us in the mid 120s roughly. And back to the point I opened with, I just think that's not even really scratching the surface of all of the other intangibles that you have with Prologis. Namely, and I'd love to get into this in our conversation, but the big one for Prologis is around development and value creation. We build $4 or $5 billion in new logistics facilities every year. There's a tremendous amount of value creation in there, roughly 30% margins on that capital invested, and a whole new opportunity set is opening up with data centers and conversions, which is something else we should touch on. So just 2 examples of kind of a myriad of things we do that aren't captured in that old school NAV assessment anyway. But if you only relied on that already illustrates a 10-15% discount. So huge undervaluation in my view.
Right. And I would say, and you also didn't mention the balance sheet, which I think gives Prologis so many huge advantages that we'll also get into. But I guess let's kind of stick with that theme of what Prologis does that separates itself. I mean, I think a few years ago you acquired Duke Realty, which was your biggest competitor at that time, and it significantly expanded Prologis' size and reach. If you look out the next 5 to 10 years, and I think you touched on some of the themes, but what do you think is Prologis' next major evolution? Do you think it now comes organically, or do you think it also could potentially also come from another big acquisition?
We acquired Duke, as you mentioned. That was the 5th of about 5 large acquisitions that we conducted between, say, 2015 and 2022. We built incredible scale over that time period. We've always said bigger is not better. Better is better. But at the same time, if I'm being honest, the scale that has brought about in terms of the competitive information that we have, market knowledge we have, data that we have, procurement abilities, it's probably been what has really driven our ability to develop adjacent businesses, et cetera. All this scale we have found tremendously beneficial to our growth in the long term. Yeah, we always look at portfolios, both public and private. You can imagine we have a list that we check in on, and we kind of look at hold, sell, how much of this is strategic, how does pricing look, and that's just a constant analysis you would expect a company like us to undertake. But that is episodic and binary. It's not the plan. The plan is the organic growth, and it's not just organic within logistics, but again, it's all the digital adjacencies, I'll call them, that we now see, which is around data, it's around energy, We should talk a little bit about energy, and then this big data center opportunity that we have, which, I should make clear here, we don't intend today to become a data center company per se. We are a logistics company. That's our expertise. But we find ourselves with a product type here, 6,000 buildings, 15,000 acres of land, that lends itself tremendously to conversion into data centers. So that is a big part of our focus.
So on that topic, Tim, one of the things, and you mentioned a little bit about it, one of the things I love about warehouses is the opportunity to convert assets to higher and better use. Can you talk a little bit more about how Prologis is converting those existing assets and using that $42 billion land bank to develop data centers? And is this something that you've done prior to data centers? Have you converted other type of property types in the past? And, is the data center business, are these assets that you plan to hold for the long term?
Yeah. So the conversion opportunity is core to a 40-year-old investment thesis, I would say, in logistics. We began as a real estate pension advisor in the 80s. That company grew into what was a public company, A&B, that eventually merged with Prologis. Now that's our history. But that early investment thesis not only favored logistics as its asset class for a handful of reasons, but one of them was to buy assets that were very close into consumption markets, supply-constrained markets, on the thesis that in addition to strong rental and value growth, the potential for higher and better use conversion into office, retail, residential, life science was there, and something that indeed we have executed on a number of times in some big ways over our history. I think that many of those product types I just mentioned often involve taking the building down. Folks are just buying that land, or we are redeveloping the land just for its location, not the building. And here with data centers is an incredible opportunity, both in terms of its scale, just so many opportunities and so much megawatts need to be delivered out there, as I'm sure you know. But, your average warehouse looks and feels a lot like a data center in its kind of bare bones anyway. So that's what has made it a super compelling opportunity to us today.
And speaking of just long-term opportunities, I mean, just going back to e-commerce, which is still a kind of a major tailwind for you. What I think the big misconception I think that investors have is that e-commerce somehow requires a lot less space than your typical brick and mortar retail operation.
Right.
And that's not true. I mean,
Right.
Prologis recently did an investor presentation at this summer's NAREIT conference. And you show that e-commerce takes about 3 times the amount of square footage than a traditional B&M operation to generate $1 billion in sales. That's obviously a huge multiplier effect for your company like yours.
Right.
Do you think that's still underappreciated by the market?
I do, and it's funny to hear you say it in the way that you did. That you think it's the opposite, because I think the same thing, and see some investors believe that as well, especially those not super close to the commercial real estate industry. But everything about e-commerce to the consumer feels efficient. But it's the exact opposite, and its reasons, just to explain, because I think it's interesting, are a fewfold. I mean, if you think about an ordinary warehouse in a brick and mortar format, let's say it's some retailer or an apparel company, it's going to have racks filled with pallets and boxes of shirts and shoes. And those boxes are never opened within the warehouse. They sit there for some period of time, get back on a truck, go to a store in the old format, and are opened up in the back of a store to go on the shelves, right? In the e-commerce model, those boxes are opened inside the warehouse, and a lot of conveyors and fulfillment, portions of the warehouse are dedicated to now individually parcelizing that for delivery to you and me. So that's a big use of additional floor space. Think about the way we're returning products. We would always take it to the store in the past. Well, now it ships back to the warehouse. Floor space is dedicated to unpacking it, getting it back on the floor for its resale. And then the other large one is just The product variety in e-commerce now is just many times greater than what you can find in a store, as you know. So all of that additional inventory is held as well. So yes, what we see is this powerful intersection of one, a climbing percentage of retail sales overall, and this is occurring in every country that we operate, as a percent of total occurring in e-commerce. And it's about 23, 24% today. And it's kind of moving up that clip at about another 1 percentage point each year. We estimate it'll grow to about 30% of retail sales by the end of the decade, for example. Wow. And all of those additional dollars flowing through are going through that 3 times multiplier. And if I can kind of go on and on here, Matt, I think the other thing that I find super interesting here is we first studied this statistic in 2011 or 12, somewhere in there, and then many others have gone on to research it and see the same multiplier effect. If you had asked me back then, well, what will that multiplier be in 10 years, where we are today? I would have said, well, I don't know, maybe it'll be 2 times, maybe it'll be 1.5 times. It'll still be good, but it won't always be 3 times. Things will get more efficient. But what's happened, it seems, is there have been great strides in efficiency from the likes of an Amazon, let's say, but it's all pouring into service levels. So the 3 times multiplier has sustained for more than a decade here, which I think is really telling, especially when you think of all the companies out there who are not Amazon and who are not yet living up to their service levels.
Each year, Prologis hosts its Groundbreakers conference, which is all about the ever-evolving world of logistics. At last year's events, CEO Hamid Moghadam mentioned that real estate has never been about the customer. It's always been about the next deal. When I look at Prologis's occupancy rate today compared to the rest of the industry, it's clear that your customers value the partnership that they have with you. Can you walk us through Prologis's customer-centric approach and how your ancillary offerings like the Essentials business, rooftop solar, you mentioned energy, how do those businesses make you the partner of choice?
Yeah, great question. And I should clarify that, just so, to be sure it's clear, Hamid was describing the way real estate had worked and how we had seen a need, an opportunity to evolve. And, I can tell that story from a personal perspective of, I've always been in real estate, commercial real estate, and mostly on the financing side of it. But I had a brief little layover at Gap Inc., the retailer, and I was in their real estate strategy group. And this was in the early 2000s. And I can attest that, especially in the case of warehousing and logistics, real estate is a cost center. It's just something you have to do. And in the era that predated e-commerce, and whether it's e-commerce or just a brick and mortar retailer's need to compete with e-commerce, the need to have inventory close into customers was not as great as it is today. And so if you were focused on cost, you could always go further down the highway to the next greenfield development, build the next warehouse, and it was all about cost and relatively just a commodity to many of our customers. What we saw evolving in the e-commerce era was that completely flipping on its head. And now actually logistics, warehouse, location, good, highly functional buildings, yes, but also very close in to rooftops and doorsteps was what was necessary. So the nature of the relationship with our customers changed. This was now a strategic advantage they could procure in their supply chain build out. And we chose to just lean into that and become much better partners in that regard. And your question about adjacent businesses that we're now offering, I think dovetails with that mindset for one, but together with all the scale conversation that I had earlier, the ability that we saw to combine the two forces into things like procurement and data and information, just all these other things that we can offer to customers by partnering with Prologis is, I would say, early stages. but something that we feel very strong about in terms of customer retention and growing those relationships. I think we're at early innings on all of that, but it's something we feel very passionate about.
So we talked a little earlier about Prologis' stock price and what looks like maybe a little bit of an unreasonable valuation, certainly from our vantage points. But one of the clouds hanging over the logistics space is just the tremendous amount of supply that came online after COVID. You guys have talked about that quite a bit, and that's caused occupancy rates across the market to dip and leasing activity to slow. But if you look at your results, Prologis' business by every metric has held up much better than the industry as a whole. And I mean, why? I go back to the same question. Why do you think the market may not be giving you enough credit for that? And do you think investors are too concerned about the current supply situation?
I think that the supply concern is waning a bit. It certainly has been with us the last two years or so. I mean, to answer your question most directly, I think there's a lot of trading that occurs kind of on second derivative and just reading into what we think the next 1 or 2 quarters headlines might be around net absorption, which is our measure of aggregate demand in our markets, or the like. But the starts and the pipeline story is really interesting. I mean, I remember sitting here in March of 2020, April of 2020, those early weeks wondering what is happening. Is the world shutting down? None of us were quite sure. And within a few months, we started realizing, like, wow, this is going to be a tremendous thing for our business because of the propelling that it did in terms of e-commerce and pulled forward a lot of adoption in e-commerce. A lot of our customers realized that their supply chains were inadequate or were broken. It reminded them of a need to have a bit less of a just-in-time inventory approach, a bit more just in case. So anyway, all that phenomena was in play, and there was a pretty mad rush around logistics in late 2020, let's say, and 2021. Values grew, rents grew tremendously, and then that drives developers into the market. So yes, there was a lot of starts across 21 and 22. Logistics development timelines are 12 to 18 months. All of that product started getting delivered into our markets across 23 and 24 in particular. And so that has built some vacancy in the market. But what we've seen since about mid-24 is that new starts have been on the decline and at some historical lows for many quarters running. So we like the setup here where the prior cycle, I should say, construction is getting absorbed. We'll see an inflection on market occupancy in the next 2 to 3 quarters is our view. And then it's going to be met with an era of low starts, at least for a while, from all the low starts that we've seen in the last 12, 18 months, as I mentioned. What's been really favorable to our business, just as the owner operator, is that leases in logistics tend to be, we call it 5 years. It's really averages more like 6 to 7 years. So they're turning over at relatively low pace. So what it means is that much of the market rent growth that we saw occur in 20, 21, 22, early 23 is still not yet in our P&L. And we measure this actively. We call it our lease mark to market. It's a measure of how much higher is market rents than the rents that are in place. And today we see that as another 22%. And in the coming years, as those leases roll, that'll be harvested. Higher percentages in early years and lower and later. And then to bring this story kind of full circle, then what we look to is, well, what's the next catalyst on market rent growth? Then what happens? And the other thing we actively measure in the business is just a concept called replacement cost rents. And you can imagine we take a look at all the land positions that we have. What is their fair market value? What are prevailing construction costs? What would the investment be to build this new building? What would be the profit margin a prototypical developer would look for? And when you put all that together, what rent would be required to compel that next development? And that measure is another 21% above market. Now, development starts, as I just mentioned, are lower today, and it's because of that 21% gap. But as the market gets tighter and new buildings need to be delivered into them, that gap needs to close. And that's what's going to be the next catalyst for market rent growth beyond working through this lease mark to market. So I think the setup, long-winded answer here, is that, it's what it's done is it's delivered continuous strong same-store growth, as we call it in our industry, and then this really favorable outlook for what the next wave will be.
That was great. Thank you. Ant?
Tim, as one of the largest logistic companies in the world, I'd like to ask you about tariffs. Like, how does the situation look like on the ground, and what are your customers saying about how trade policy uncertainty is affecting their businesses?
Yeah, well, let me start by just highlighting Prologis's investment strategy, which is to be around the consumer. So if you imagine a supply chain end to end, the first side of it is going to be where goods are produced. You're going to have logistics and warehouse facilities dedicated to storing raw materials, dedicated to the fabrication and manufacturing. You might store finished materials, et cetera. That's a big part of the supply chain. We don't do any of that. We pick up thereafter and are focused on regional distribution, market-wide distribution, last mile, a city center kind of distribution. And we do that in the large consumption markets of the globe. So it's LA, San Francisco, New York, Chicago, Tokyo, London, et cetera. So you can imagine then with that strategy, you might look at where are goods going to be produced? Is it moving materially out of China to Vietnam? Is it headed to India? What about nearshoring in Mexico? We need to be mindful of all those things. We watch those things. But actually, for what's the constant source of growth and demand in our markets, we're relatively agnostic to it. And, being, really honest about it, we get the other version of this question is, do you see onshoring of manufacturing in the U.S. as a big growth driver for your business? And I can't talk out of both sides of my mouth. I would say no. We don't. One, because we're just not sure how much of that will ultimately come onshore. And it is in some important industries, as we know, but there are going to be many industries, many large volumes of it that may be difficult to tackle. But even if it does, it's not likely to be in a prototypical Prologis market, which is going to be a larger, more populated, more affluent market like the ones that I mentioned. So long way of saying, I think we feel quite insulated from all of that outside of the macro. In terms of what our customers are saying, we spent a bit of time on this topic in our July earnings call because we had a good 100 days of activity with our customers absorbing the news of Liberation Day and the tariffs. And what we had learned from them over that time period was that many of them needed to just get on with their business, so to speak. Not all of them, but we saw headlines change pretty frequently, pauses, resumptions of tariffs, different levels. And, supply chains are so integral to their businesses. We found that many of them just can't delay decision-making any further and are proceeding with making what are some longer term plans in their businesses. I would say we saw this most prominently in larger, well-capitalized companies, as you can imagine, and they're making those decisions in build-to-suit development projects that they're conducting with us. We had actually our highest 6-month volume of build-to-suit activity in the first 2 quarters of this year. And that, I feel, is a leading indicator on our customer sentiment of needing to just kind of look past the tariffs, knowing that you can make some adjustments in your supply chain post, but get on with planning out the reconfiguration and modernization of your supply chain.
Thanks for that, Tim. And I think that talk about uncertainty is a nice segue to talk about Prologis' balance sheet. Today, debt as a percentage of market cap is just about 28%. Your average remaining debt doesn't mature for more than 8 years. And you've historically had one of the lowest, if not the lowest, borrowing costs in the REIT sector. So it seems like a common theme throughout Prologis' history that you've always had access to capital when others didn't. So can you talk about how Prologis balances investing for growth while also maintaining a strong financial position to not only withstand downturns, but to take advantage of potential opportunities that may arise?
Yeah. Well, sitting in the treasurer's seat for roughly 10 years prior to this role, it's something I'm very proud of. Had a big team help me deliver on, of course. It's worth mentioning Prologis is a flat rated REIT with Moody's and S&P, which might not sound so high to some of your listeners, but that is the highest rated REIT. REITs just tend to be a little bit lower rated, and that's because credit metrics, as traditionally measured, can appear high for most trade businesses, but not for asset owning businesses. When you have $200 billion of assets against $40 billion of debt or so, obviously that's a tremendous amount of equity value. So the ratings are quite strong. Look, we have, I would say we found religion. A lot of companies did in the GFC, the Great Financial Crisis. It was a period where a lot of companies, and in particular real estate companies, learned some new lessons on leverage. I would say A and B, where I was at the time, as I mentioned prior to that merger, wasn't excessively leveraged. We were maybe 40-45% leveraged going into that crisis. But it reset the way a lot of companies look at leverage. And we in particular, we were dedicated to not just strengthening the balance sheet out of that crisis, but becoming the strongest balance sheet amongst all REITs. And I think we got there. I think others would endorse that opinion. And it's now just a core part of our strategy. As you mentioned, the ability it gives us to not just be protective and mitigate risk through cycles, but also be opportunistic as opportunities come around, whether that's large-scale public M&A and taking on any effects that could have, or just outright asset purchases. A couple of years ago, we bought a $3 billion portfolio. It was fully financed with debt, and it barely moved our metrics, given how low the metrics are on their own and just the sheer scale of the company. So we're very protective and proud of the balance sheet, and it is a huge competitive advantage.
So kind of a related question. CEO Hamid Moghadam did an interview back in 2019 where he mentioned that Prologis tries to have an annual cash dividend that's less than the annual debt maturity in any given year. That way, there's some type of debt maturity crisis, you could simply suspend the dividend, repay the debt. So you're essentially not relying on the banks to continually refinance your debt. Is that a metric that Prologis actively manages to, or is that more of a byproduct of sound balance sheet management?
Both. I think it's a smart strategy, and yes, we actively measure to it amongst a myriad of things. Look, our dividend is pretty incredible. We send about $4 billion out every year in dividends today. And so, yeah, you can take a look at our debt maturity schedule, which is principally out in the unsecured bond market, by the way. We do a lot of business with banks, but most of our financing comes from the bond market, where we're really able to leverage and take advantage of those low credit spreads. But as you examine our maturity schedule, you'll see maturities never in excess of that $4 billion number, and in many years meaningfully inside of it.
So maybe following up on the dividend a little bit, and without breaking any news here, but if you had to predict what Prologis' dividend growth might look like over the next several years, and would you care to throw out maybe a number or a growth rate?
Well, look, I would do it this way, that I might be a little soft in answering because, in a REIT, your dividend growth rate is pretty much going to approximate your earnings growth rate. And so I don't want to, find myself giving earnings guidance right now unintentionally. But, the REIT rules require that you distribute all of your taxable income, and taxable income is going to be a good proxy for the main earnings metric in our business, which is either FFO, funds from operation, or others will review a metric called AFFO, which contemplates some of the CapEx of our business. And the long-term growth profile of our business has been Same store growth. Same store growth is fueled by market rent growth and changes in occupancy. That has been in the mid to high single digits in recent years. That'll probably settle in the mid single digits. We're about 4% this year, for example. If you think about market rent growth in our industry, we think it should be inflation plus. So there's a number of ways you can think about what that foundation is. Then we just have all these other things at Prologis, as I mentioned, going back to the valuation question. One thing we haven't touched on, by the way, is we have an asset management business. It's a very important part of our capital structure. About $90 billion of our assets sits in an asset management business. We refer to it as strategic capital. It earns fees. It earns promotes. That's a earnings enhancer. It drives down to the bottom line growth. The value creation that comes about from development, either in logistics facilities or data centers, gets reinvested into the business. That's a kicker on the growth rate. And then some of these adjacent businesses around solar energy. We're big installer and generator of solar power and its related storage. That's a young business for us. That's just growing. So the essentials business, all these things became the additions to that foundational market rent growth kicker that ultimately will drive dividend growth.
And Tim, on earnings calls, analysts are always trying to figure out what's going to happen, what's going to change in the future, and in particular, what's going to happen next quarter. So I've always liked how Prologis takes a long-term mindset. So I want to kind of invert that thinking and ask, what's not going to change for Prologis when you look out, say, 10 years from now? What aspects of Prologis' business will endure up cycles, down cycles, and constant evolution in technology?
Well, that is a great question. It's such a refreshing twist. I really appreciate that. Look, I think the nature of your question is like, what are the secular drivers for our space too? So there's going to be some Prologis specific things I'll touch on, but just on the secular side, one, as I mentioned, is e-commerce is still very much a growth driver for the business. That 3 times multiplier, the continued penetration of how much a retail sales will it take over time. There's still a lot of runway on that. And in particular, in different geographies that we operate. I mean, the U.S. is relatively mature, but other countries that we operate in, Mexico, just one example, is moving along, but e-commerce is newer there. So there's a lot of growth in just different geographies that we operate in. So that's an important piece. I think the flip side on the secular story is then supply, as we've talked about. We love to say they're not making any more land. Think about how much more land a typical warehouse requires. It's 1 or 2 dozen acres, let's call it. You need flat, contiguous land. You want it close into populations. And frankly, it's a product type. This is good and bad. I think it's mostly good that there's NIMBYism around, right? People don't want a warehouse in their neighborhood necessarily. And we see that in a pretty big way here in California. There's new legislation that has come along in this last year called AB 98 that's restricting new warehouse development in certain cases. So for our development teams, that's a real headache. But when you have large incumbent portfolios and that kind of headwind on new supply, that's a very powerful secular driver as well. As I think about real estate generally, and I love it as a business, you can tell, I think logistics stands out as one where the propensity or the ability to be disrupted from technology is just less than we had seen in Airbnb and VRBO to hotels or Zoom to office or e-commerce to retail, because ours is a physical proposition. I mean, we need to store sneakers and iPads and toilet paper in buildings and move them around the economy. And until you find a way to do that in a very different way, which I don't imagine what that could possibly be as a physical concept, the enduring need for its demand and the intersection of what's going to happen to further propel it against limited supply, I think it's just an outstanding setup for us. Then you put a company that has a scale that we have, portfolio quality that we have, We care about customers. We care about innovation. We care about like squeezing everything out of a platform like this. I think that's just the horse you would want to ride in this space.
That's great, Tim. We'll end on this question, and maybe it's a little unfair to ask you, but what is one thing you would say to shareholders about President Dan Leder, who we know is going to be taking over the CEO from Hamid, the CEO role from Hamid in January? Anything we should know about him?
Well, Dan is a great guy. Dan and I both started at this company in the same year, 2004. It's interesting. We've only gotten to know each other in a very close way in the last 4 or 5 years, I would say, because in that prior 15 years, we grew up in very different paths. I was here in corporate HQ doing all the finance things that I mentioned, and Dan was out in the world running markets, running regions, became our global chief investment officer, did a lot of novel development, multi-story development here in the U.S., just did so many things that, led him to becoming the choice as Hamid's successor, which is in both our cases, a huge honor to receive that trust from Hamid. I think what I see across Dan and I, both spending so much time at the company and with Hamid, is all of the philosophies you've heard about in this last 40 minutes or so about protecting the balance sheet and staying close to customers and favor infill close in real estate, all the investment thesis and financing thesis we believe in and have been trained on, for 2 decades, and that's steeped in the way we look at the company. So anyone who likes Prologis and has been a fan of our story and liked in particular Hamid and everything he brought to this company, we're firm believers in and are going to continue to execute on. What I think the new EC brings about is you've got a lot of folks who grew up at this company, from analyst to director to VP, had all kinds of roles. And so I feel like you get all that with like a different perspective on execution and how to get some things done. And so I'm hopeful that Dan and I and the rest of the EC and new leadership team can be even more effective and nimble in our execution. That's definitely what we have our eyes on, with the same investment thesis and the world's best portfolio to work from. So we're in a great position.
Well, Tim, that was great. Thank you so much for your time today. Best of luck to you and the team at Prologis. I think I can say on behalf of all Prologis shareholders, which includes Anthony and me, by the way, that we're really grateful for your stewardship of the company and really excited about the years ahead for Prologis. So Great. Thank you so much.
Great. Thank you, Matt. Thanks, Anthony.